Hello, today is the 12th day of December 2012. Thank you for tuning in. This will be a gold technical analysis video. And before the charts, let's go over a headline found on CNBC.com and probably other major economic news sources. Fed to keep easing, sets targets for rates. The headline should tell you the whole story. The Federal Reserve met market expectations Wednesday with another round of easing, this time with a pledge to keep interest rates low until unemployment falls below 6.5% and inflation tops 2.5%. They're already working with incorrect data to begin with. At least anyone barely or partially paying attention would know that's incorrect data, let alone someone who's paying attention even more. Economists had been expecting the Federal Reserve to accelerate its debt buying program known as quantitative easing to the tune of another $45 billion a month, and the central bank came through. I don't know how they just write this really well. I don't know how I could write this better. And of course, it's accelerating its debt buying program. After all, we're in an economic model where central banks are the only ones that can mine its fiat currency, thus guaranteeing debt to its largest levels, basically, or extreme levels. So of course it's got to accelerate the debt buying program. And you just got to love the way they say that banks came through. It's just so priceless. Coupled with its move to buy $40 billion of mortgage-backed securities a month, that would bring the Fed balance sheet expansion to another $1 trillion or so in 2013 and $4 trillion overall. $1 trillion or so is like, well, it's going to cost me $20 or so to do this. Something like it's not much or something, yeah. And then the bottom paragraph, the move essentially keeps the Fed in the easing business indefinitely, as the jobless rate has been stubbornly high for the past 4 years and shows little inclination lower except for statistical irritations caused by people leaving the workforce. It's right there. You show this wrong numbers. They're telling you, if you can understand it, that this is the wrong numbers. And you just gotta love it. The jobless rate has been stubbornly high. Oh, it's just priceless to say the least. Anyway, on to the gold charts now. We're going to take a look at the daily, the weekly, the monthly, and the yearly charts. This is the daily, and well, what we're seeing upon this is you had your move higher correction of 38.2% that is held on 2 support hits so far. And what's interesting is, okay, so you established a higher low from the last breakout level, and then you make a lower high and a higher low, and if this is a high, this would be a lower high. So it's a little bit of an indecisive move. Now, they announced QE, I don't know what number we're at. Was it 4 or something today? I don't know. 5? I don't know what number we're on. It's like the Friday the 13th. The sequels get bad and bad and bad. And Jason never died. Okay, so this is the daily chart for gold. Let's move this on now to the weekly chart. And this one, I like the pattern of this one better because I like it. You have the situation where you're in this wedge here within the 18 average, and there's your breakout period. Okay, so now you got back up to the previous high. It's a triple match now. And it's in within this band. So the playbook tells me any clear breakout above here has a good opportunity of at least testing this level and probably even a good chance later on of breaking it because of these higher lows that have been put in place. So things are actually looking to get very, very good, basically. On the monthly chart, we see this sideways consolidation, which is this here. We can take a look at this on the monthly chart and see that that sideways consolidation is nothing more than this. So within the correctionary phase, it's been in a decent uptrend, to say the least. It doesn't really matter how you draw the lines in. It's obviously a clear uptrend, to say the least. And a lot of people might call this a bull flag. It's another way of showing a sideways correction. Basically, the only decent corrections there have been is this one. There's been sideways in here, and now of course this one as well. And now let's move this on to the yearly chart. Now I'm only going to put in all the candles from 1960. I think this pretty much tells the exact story, as this gives you an up move, sideways, and we're in the up move. Is there any signs that the up move is over as of yet? I don't see any, but this is now 12 straight up years in a row, 12 green candles in a row. Every single, and if you look at, notice higher low in every single one of these years. Every year has made a higher low, going back to like 2000. As far as the highs are concerned, higher highs. Okay, not this one. Unless, of course, it can find a way to get over 1920 in the next few weeks, which I doubt it will. It's going to make an inside year, which means the high is lower than 1920 and higher than the this low in here. For it to have a close, it's got to not lose like 9% the rest of the way. So again, it should be an up year. It should be an inside year. Now, an inside period is where you have the high lower and the low higher. As far as it being a bullish or bearish indicator, generally speaking, it matches whatever the trend is. If the trend is higher or a bullish trend, then usually it's a bullish indicator. And in a downtrend, it would be that of a bearish indicator. So therefore, it's a bullish indicator as I'm looking at this right now. So therefore, I've been, the last few days, been making 2013 predictions. I'm probably going to make a bunch more throughout the rest of the few days ending to 2012. And the next one will be what gold does in 2013. So its prediction would be this. The price of gold will be higher on the 2013 close than it was or will be on this year's 2012 close. Therefore, I'm predicting the 13th straight up year, especially with, of course, the inside year. It could be a pretty decent size up year. And thank you for tuning in. Take care. Bye-bye.